Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right. Good morning. Welcome to the BOGART Effect. This is James Bogart. I've got Morgan Veth with me, and we are going to be talking about using debt in relationship to your portfolio today.
Yeah. Good
Thank
morning.
you, Morgan. Appreciate the time.
Absolutely. Thanks for having me.
So this is a conversation that we have a lot with our clients around how to appropriately use debt. I think there's a lot of biases that debt is bad, that all debt is bad, especially as you move into retirement. And I think it's worthy of a conversation because I think, for me, the main driver with regards to debt is around someone's actual comfort level with risk.
Yep.
And I'll frame it kind of in the sense of like the decision to have a mortgage. I would put mortgages in the category of very responsible, good debt, right? It's collateralized based on an asset. The interest rates are pretty low. Again, it's all relative, right? But when you think about what you're borrowing at versus what your portfolio most likely is performing at, that's a worthy conversation. So
Absolutely.
I think, from my lens, today's goal is really to talk about when to use debt or leverage in some form or fashion, and when not to. Anything you want to make sure we add to that, or?
Yeah. And I think it's just also, kind of hearing some examples of also for someone like when to pause and say, well, let me talk to my advisor, right? Because I think for some, there's this default option of, oh, I don't want to do it. I want to pay cash for this or that. But it's like, hey, here's some parameters to your point. Where are rates? What's the use of this, right? What are kind of the terms so that we can analyze it versus others to say, hey, is it a good use of it? Right. And thinking about it.
I would say too, like the landscape just in the last 5 years has changed so materially with what interest rates have done, right? Like I remember vividly that 2020, 2021, 2022 era when, goodness, you were getting car loans at 0%.
Everyone was refinancing.
Mortgage rates, the hardest thing I ever did was sell a house that had a 2.875% mortgage rate.
Painful.
Yeah, especially with where mortgage rates are now, it's like, dagger. But I guess that's a perfect segue into what is bad debt? Like, let's talk a little bit about that and frame these conversations, and then we'll talk a little bit about what we think is good debt.
Yeah, not to oversimplify it, but for me, bad debt is spending outside your means. It's that slippery slope of piling things on a credit card. Look, if you're using your credit card and paying it off every month, if it's revolving, right, is the term where you're just paying it off, getting some points, sure, do that. But I think it's when, for me, bad debt comes to mind is just you're spending above your means, right? And you're probably paying a ridiculously high interest rate, 20, 30%. You don't feel it, right? Because it's funny money, you're making a minimum payment. But I think that is really, to me, the key definition of bad debt.
And maybe take a quick step back, right? Like I know in the prep we were talking about the integration of a financial plan and how I personally believe everyone, regardless of age, needs to have a financial plan. Yep. And part of that financial plan is having a budget and understanding how that budget interface into your long-term goals and objectives. And I recognize, and I'll use myself, my 20s, life was not always easy, right? Like everything is chipping away at the same dollar. You have that natural tension of wanting to keep up with the Joneses, or
you're in wedding season, right? So you got to go to all these weddings and trips. It's expensive.
Yeah. And you can't say no, right? No. Like, and it's, for guys, it's the bachelor party and the wedding, right? Like, and so it's one of those where it's very easy to fall down that pathway. And then next thing you know, things are hitting the credit card, and the credit card's a little heavy. And, I'll tell you in our line of work, there's not always consistency of cash flow, right? Yep. Like, especially when I was mostly in a sales capacity, you'd have a great month and then you'd have like 6 months of nothing, right? And then, it was just very lumpy. And so, I think it all depends a smidge on like where your let's say, consistency of income and cash flow comes from,
Yep.
and then how you build your budget associated with that.
Absolutely.
And to me, I understand completely. There were points in time I had credit card balances that moved to, from just being 1 month, right?
Exactly.
But recognizing like that's what drove in some of the need from my viewpoint on building those emergency funds and building up cash buffers to be able to manage that utilization of debt in a very safe and responsible manner. So, when we frame debt, right? Like you're absolutely right. I think it's a very basic math equation. Look at what's coming in and what's going out and making sure that you're able to live within that budget. And I think it does depend on kind of what I was just saying. The type of consistency of income you have naturally predicates like how you manage your cash flows. So again, I don't have a consistent monthly cash flow, right? Like it moves. And because it moves, I need to maintain a higher cash buffer personally, right? And because of that, I'm able to manage my cash flows based on the buffer. And then as a quarterly distribution happens, like I'm able to kind of balance it out. That's me. Some people have, let's just say the Fortune 500 companies where you have a very consistent, reliable income and it's predictable, right? And because it's predictable, you can manage your cash flows, let's just say better. But even with the most predictable level of income, things still happen, right? Like the roof breaks.
That's why you want to look at it over a year too, right? To your point, month to month, quarter to quarter, because even if your income's consistent, your expenses might not be. I know I definitely have periods of time, right, where things are a little bit more expensive, right? I've got summer camps for the kids and things just kind of pile up, or end of year and the holidays for some. So even if your income's consistent, expenses aren't always, which is why with the financial plan, where we always want to start, it's, hey, let's average it out and look at a year for both expenses and income.
And actually, I think it's one thing while someone's working to look at their expenses, but as you and I both know, when they transition into retirement, we actually don't know what they're going to spend until probably 18 months in, because life is very different as you move from working environment to not working environment. I call it the accumulation phase of life and then the deaccumulation phase of life. But back to debt, right? The reality of it is if we see high balances on credit cards, that usually is a pretty good sign on a consistent basis that we're not able to live within the means that we have right now. Now, that's not to say that, I think there's a lot of people, most of society, frankly, that's why the credit card companies are such great performing investments from an equity ownership perspective. But a lot of people go through this, and I don't want to immediately jump to if you have credit card debt, you're an awful person. That's not what we're saying by any means. But the reality of it is being able to manage debt in a responsible basis is a good frame of lens to start with, and then from there we can start talking about how to utilize debt in a prudent manner on a go forward basis. But I would say bad debt is credit card debt.
Exactly. But to your point, kind of in the launch, I think there is a stigma around it that just the word debt is bad. Right. And it's not necessarily. So yes, that is bad, but there's good,
Yeah. And I think it has to be done with an intentional manner around it, right? Like if you're going to utilize debt. So probably a good segue. Let's talk a little bit about good debt. What is good debt?
Yeah. Good debt is when you're able to, typically we're looking at something with a low interest rate. For me, it usually comes down to bad debt. We're going, okay, I've got this one-off expense. I don't have the cash. It isn't an option, right? If you're going for it, it's going on the credit card, right? So otherwise, if I think about good debt, it's usually someone saying, hey, how do I finance this, right? I might have the option to sell a stock, pull from an IRA. I might have a liquidity pool, but is that the best option? Then we can look at, again, what I would classify as good debt, right? A mortgage is the most common, right? Kind of good debt, most universal term people think about, right? That's an IOU.
I would describe it as a collateralized asset, right?
Yeah.
Let's say you buy a house and yes, a mortgage is a way of helping you accumulate that asset or acquire that asset. Look at cars, right? Cars to me is actually the very easy one because, the decision to buy a car, if you could pay cash, that's in most instances probably the right play. However, there are now credit facilities where, goodness, I was able to get a car recently with sub 4% debt.
Right.
That's not a bad interest rate.
Yep.
Now, on the flip side, I've seen clients come in where they're trying to help their kids. Just helped with one recently where it was a 9.87% debt to buy the car. And I'm like, that's probably not good.
Right.
So we should look at buying a cheaper car, buying a used car, right? Like this comes back to that like, where are we at in life conversation, right?
Evaluate it, right? In the context of all the other factors.
And what mom and dad were trying to do to help their child was they were going to be the bank, right? And they were going to buy the car and let them pay interest off of it, which, okay, now we're starting to think a little bit more responsibly, lower interest rate, right?
Exactly.
Like easy to help acquire. But that's mom and dad stepping in. The point that I'm making is like with buying a car, for example, it's actually really easy to make the call because if the interest rate is below what your portfolio is able to perform at, then I'm typically going to bias to go ahead and use the debt because at that point in time, you have the assets. As long as it's being invested in a manner that's going to outperform the interest rate, then I'm all for being okay with some level of debt.
Absolutely.
The second that we have the assets that are not put in a way that are going to outperform what the interest rates are, then I start to fundamentally question the decision.
Right. If someone's saying, hey, my cash could either stay in cash, a bank, high interest rate, whatever, maybe it's getting 3-4%, or I could pay 6% on a car, right? That's different versus what you're talking about. We're usually saying, well, what can the portfolio? It's money that's invested and working for them versus that fixed rate that they're being offered.
Bingo. Exactly. And again, there are points in time where I might have the cash that sits in the money markets, right? That are getting the 3-4%. But because I've got other things sequencing, I might still be okay with a little, let's just use the 6% that you're talking about. That might make sense because of cash flows, right? The point that I think that both of us are dancing around is we need to integrate the utilization of debt into an overall financial plan. Right. And it can't just be month to month. Usually it's year to year. And we're making sure that we're sequencing these conversations in an intentional manner around when do we need to have the funds? What are the interest rates that we're paying?
Exactly.
And then what are some of the other decisions that are going into this? So I think, we've talked a little bit about utilization of leveraging good debt.
Yep.
Let's talk a smidge about capital gains and tax implications of sourcing the funds.
Yeah, absolutely.
I'll hand that to you.
Yeah. And so we don't want taxes to be the driving decision, but they absolutely are part of it, right? I mean, that is at the core of what we do, right? We integrate taxes into the financial plan. One thing I love about BOGART. But, looking at something saying, okay, well, again, from a financing standpoint, I could sell something at a capital gain. Okay, what is my tax to take on that capital gain? What is my outlook on that position? Hey, if I still feel like ABC stocks has a lot of room to grow, forget the taxes, maybe I want to keep it and leverage it, right? I think my portfolio can earn more that way, but also taking a look at the tax implications of it. What I don't want to see is to your point where someone goes, okay, I'll take on the 9% interest because I just don't want to pay the capital gain. Well, let's do the math. Like we can very easily give you exact numbers to do a fair comparison. That doesn't have to be kind of a gray, ambiguous thing. We know what capital gains rates are if we sell. So really looking to say, is it worth it to take on the capital gain, or do we want to defer that because that and a combination of, hey, we think it's going to continue to still go up, maybe let's take the debt and kind of let the portfolio grow.
And I want to just give an example here. I remember vividly 2020, and I won't name the stock itself, but the stock position was trading almost at a 60% discount from where it was a year and a half before. Fundamentally, I had every bit of conviction the stock was going to go back up to at least where it was. So there were a lot of instances, whether it was cash flows or buying something, right? That's an example where I'm not market timing by any means, but like not selling that position in a down period of time when it was being impacted like that and getting a mortgage or maybe getting a car loan made a lot of sense. And it wasn't the tax driver. That was a performance driver at that point.
Exactly.
Now, on the flip side, right, that same stock is trading, let's just say, near all-time highs right now. And I've actually become more of a, let's just say, internal raving disciple of now is the time to sell.
Right.
Regardless of tax implications. That's not fair. But it's one where I would say tax implications are becoming a secondary conversation relative to where it's trading at from a market performance perspective. Now, the other thing that came to mind when we were prepping on this for me was, let's say, for example, the asset composition of your portfolio is a very big driver. Like you just mentioned, capital gains. Well, that means that you have stock that's in a brokerage account.
Right.
Not everybody's in that position, right? Yep. Like if most of their portfolio is trading is accumulated in a traditional IRA,
yep.
Well, to take money out of an IRA is all ordinary income.
Exactly.
And that might not make sense. Like let's use the example of buying $1 million house. And if we're buying this $1 million house, to pull $1 million out of an IRA account where you're paying ordinary income on that entire amount, like you're materially moving your taxable income up.
You're touching just the top bracket, right? No questions asked.
Without a doubt. Yeah. And so, plus you're probably living, like you've got other things that you need, right? Like, so that's a very expensive acquisition. Again, I'll emphasize the point. I don't let the tax dog wag the tail, if you will. But the point being is that's another great example where buying the house with a mortgage actually would make a lot of sense so that we can now spread out. And let's just assume we follow the same lens that we do not want debt.
Right.
But it would make a lot of sense to buy the house with a mortgage, put the 20 or 30% down. And then over the next 3, 5, maybe 10 years, we pay the mortgage down in a more ratable and incremental manner, as opposed to materially moving our tax bracket up all in 1 year.
Yeah.
And that's, again, not to belabor the point around having a financial plan, but that's exactly why we have that plan, integrate this tax conversation of what is the most safe, responsible, and prudent way to be able to utilize debt within the comprehensive nature of your portfolio, right?
Because it could be middle ground, what you just described, right? One is taking $1 million out, right? That's the extreme to pay cash. One is just putting down the 20% and kind of mortgaging it and just taking the mortgage as is, right, through the normal schedule. But there's also just, hey, you take the mortgage, but we make additional payments, right? If that's important to you to retire debt in retirement, which I think a lot of people do have that viewpoint, then a mortgage isn't always a bad thing. It's, hey, let's take it, but we can work with you to say what makes sense if you do want to make extra payments, right?
Bingo. Yeah, and I think, I mentioned it earlier on, but I think a lot of this conversation still comes back to risk profile, right? Yeah. And it's not uncommon, by the way, and I know you and I have similar clients that have this, where one spouse has one risk profile and the other spouse has a completely different risk profile.
That's how they always are.
Ironically, my wife is more aggressive than I am. It's
That's
kind of hard to
interesting.
believe.
Yeah.
But I do think that it's one of those things where we need to make sure that we're aligning fundamentally on the combined risk profile of husband and wife in that scenario. But it comes back to, how is the money being invested if it's not used to pay off the debt?
Right.
And this is where we keep talking about the integration, but the integration of a financial plan with the investments, with tax, is so important to make sure that those are all aligned appropriately, right?
Exactly.
So I think let's talk a little bit about risk reward, some of the trade-offs. I know we've kind of danced around it. Let's dive into it, right?
Yeah.
I think cash flows are a big conversation that usually drive this, especially when we move to deaccumulation mode. Yep. But I also think it's not just when you're retired, it's also while you're working. Like making sure, I talked about some of the lumpy nature of someone's income.
Yep.
And let's use a great example, college expenses. Goodness gracious, those are shooting through the moon. But the point is like, that's an expense that, unless we've already built up the savings buffer to pay for it,
right?
If we need to fund that out of cash flows, that's a whole other conversation that needs to be had, right?
Exactly.
And that's one where it's not uncommon that I see, like, for example, someone get like restricted stock grant right at the end of the year. All right, well, that's my college expenses,
exactly.
Right?
That's a key use of it usually.
Bridge it, throughout the year, the other expenses associated with it, and then we have the influx that happens.
Right.
My personal preference is, let's get ahead of it as much as we can.
Absolutely.
Again, belabor the point about the financial plan, but like, get ahead of it. But if you can't, let's look at responsible ways to be able to either borrow against our portfolio using something like a margin loan,
yep.
right? Especially if a position is got either big tax implications or it's not at a place where we would want to sell it.
Right.
I like home equity lines of credit potentially for these types
yep.
of things. The interest rates are relatively low. We can tap on, and then as soon as that restricted stock comes in or the stock gets back to a place that we're comfortable selling, we go ahead and utilize that. Any other options I'm missing?
The other one I think of is, this is very short term, but I've used it a couple of times, is like a 60-day rollover, right? So if you think about your IRA, and this is short term, but it could be just a bridge right before your RSUs come in, your bonus comes in, or we're looking to, take something over to tax years, whatever it might be. But you can pull money from your retirement account. And within 60 days, and the IRS is very strict about that, right? So you've got 60 days to return the money. And if you do, it's as if it never came out, right? There's no ordinary income. Once a year. But I would say that's one that I've brought up and most people don't know about it, right? And again, so it is a very specific need, but another reason to say, hey, let me call my advisor and say if I thought about every single loan option that I could.
I have done that a few times in my career, and I will tell you that 60 days, I'm not, I've done it for clients, to be clear, right? And that 60 days is stressful.
It is. Yes, like underscoring, underlining, like there's no ifs, ands, or buts. And it could be a partial return, right? So let's say you take it out and you can't fully return it, or maybe that's the plan that, it won't all come back. But if you take out 100, give back 50, well, the net's your 50 distributions.
Yeah. The only caveat I'll put there is that works, let's just say, with no risk on once you're over 59 and a half.
Right.
If you're doing it when you're under 59 and a half, there's a 10% penalty on any amount that doesn't get returned within that 60-day window. So just, again, full education around that strategy.
Yep.
The times I've done it.
It's my last one I used it, right? Yeah. It's probably at the bottom of the list to go to, but it could work. It can certainly help.
Yeah. I'm going to lead with let's try to anticipate the expense as much as we can and structure the savings. But if
plan for the unplanned expense, but that's something to think about.
But to your point, I actually get asked this question a lot around margin and what margin is, or even these portfolio access lines.
Yep.
Both of them are lending facilities off of your portfolio. But the only assets that can be used for those are after-tax, non-qualified assets, right? So IRAs and Roth IRAs cannot be borrowed against, at all, right? That's not an option. So in order to be able to use margin or portfolio access lines, you have to have non-qualified assets, so brokerage accounts, right? And it's usually appreciated stock. Sometimes, you can have cash in those accounts, et cetera. But it's an after-tax, non-qualified accounts. And just real quick, because I mentioned it, the difference between margin and portfolio access lines really just comes down to how they are structured. Margin loans are something that are typically offered by the custodians directly. And so it's one where you can borrow up to 55% of the assets. The interest rate is variable. So right now it's Fed funds plus a spread. Now, Bogart Wealth has a negotiated spread for all of our clients, and sometimes I can argue a little bit, right? Don't tell Schwab I said that, but sometimes I can fight to get a little lower rate. But that's margin. And the one thing I'll say about margin is it is fully deductible on your tax returns as an investment expense. Then we compare that to portfolio access lines. So portfolio access lines, I almost kind of think about more as a mortgage on my portfolio.
Right.
A little bit more structured.
Bigger margin loan.
Little more structured. They're offered not only by the custodians, if this custodian has a banking relationship, like Schwab has a portfolio access line department, but we also can go to third-party banks and get a little bit more competitive on the rates sometimes. Yeah. So it's one where we talk about the integration of a financial plan. I think it's really, really important to make sure if we're thinking about these types of things, that we look at all of our options associated with it. That's all. A lot of times I see the portfolio access lines for people who are doing real estate, a lot of real estate investments.
Especially like investment for homes and so forth.
We have a client that bought a commercial real estate building using a portfolio access line. It's easier to go that route than it is to go through a bank to try to get a structured facility, right? So things of that sort. And by the way, those are collateralized assets. So because it's being held with collateral against it, the interest rates are lower relative to, for example, revolving lines like credit cards.
Right.
And even
much more favorable.
Some of the highest qualified people that I've seen, credit card rates are still high 17, 18, 19%. That's like really well qualified. And obviously, if you have credit issues, I've actually seen credit card interest rates as high as 35%.
Oh, yeah.
And
that's why it's in the category of bad debt. Right?
But how does somebody ever recover from that? Like, sorry, I'm being a little flip, but the point is like that to me, yeah, bad debt is a great way of describing it. And just, it's really hard to get out of that when you're paying that level of interest rate. Now, just to walk through a scenario, like if I see somebody who's let's just say looking to consolidate debt, the first thing that I like to look at is what are the assets that we have that we can look to potentially either refinance and get a lower debt structure so we can help with paying these things down faster. What is the potential sequencing of funds that are coming in, right? One of the things that I find with like debt consolidation is if we can get the rate down and make it so that the payment is not as unbearable, we can then accelerate pay downs as quickly as possible. And I know that this is, really just trying to give financial guidance. A lot of times we see the kids of our clients, this is what happens to them. And of course, it's mom and dad usually coming in saying, hey, can I, it's the conversation with us of should we pay it down for them, right? And then should we be the bank for them? That's a personal decision. And frankly, we have entire podcasts off of that. But the point that I'm making is that a lot of times it's actually better to educate them on how to facilitate this themselves. Because what ends up happening is the typical scenario I see is we pay it off and it's not much longer before that debt comes back. And that's what we're trying to avoid. Like, this is a financial literacy conversation more than anything else, right? We're trying to pay off the bad debt and be okay maintaining good debt, right? Like,
build your wealth so that you can have more of the good debt, right?
Well, and so it's an inventory, right? It's an inventory of what's bad, what's good. Let's get rid of the bad, maintain the good, right? Yeah. And if there's a scenario, like for example, let's say the kid owns a home. Well, if maybe we get a home equity line of credit, right? And again, I'm not advocating for more debt. What I'm trying to do is restructure the debt to get it to a lower interest rate environment.
Exactly.
So then they can be more aggressive paying off the home equity line of credit, as an example. And that's managing this stuff is one where it's really, really important. And I'm not trying to pick on the client's kids, but that's where we typically see it the most. Right. Recognizing, your 20s and 30s are the hardest years, and everything's chipping away at the same dollars, and kids are expensive, and frankly, inflation is a real thing right now, and I recognize that. But we need to build this financial literacy component to these conversations to really empower them for long-term future success.
Yep.
All right, that was my little tangent.
It was a good one. It was noteworthy,
is there
right?
Anything you want to add on using debt wisely?
No, I think, one part is, building up your emergency fund, right? So that you're putting yourself in a better position to not have to go into the bad debt, right? Easier said than done, but part of that sequencing and kind of building that up so you've got your sleep at night money, because there will be an unexpected. So just really positioning yourself to be able to do that. And then I think when it comes down to the good debt, it's just what's the best way to finance something is the way I kind of think of it. And talk to your advisor so you can say, have I thought of every single instrument possible? Because the pledged asset loans, the margin, so using the non-retirement assets, I find I've brought that up a number of times. I was like, I never knew, right? Maybe you knew margin existed. You didn't know there was a pledged asset line that would give you even more access to it. So just give yourself a chance to talk to someone to make sure we're looking at the best way to do it.
And I would say for all of our clients, encourage your kids to talk to us. We have an army of resources to be available to them, and it doesn't cost them anything, right? Like, let us help them put themselves onto a good foundational pathway. And it's no harder than building a plan, right? And recognizing, this is not a shame conversation by any means. We all go through periods of life that are harder than others. And, finding that pathway to build like long-term financial success, I think is extremely empowering. And one thing I will say too is even if this is not necessarily a financial piece of advice, but like, don't let the fact that you've accumulated debt disable you from being able to enjoy life, right? Like, I think that's one where people feel ashamed of it. And by the way, please don't take it the other way, right? Of like, just go rack up more debt, right? But like, recognizing there are hard periods of time in life that it happens, right? And heck, I went through it myself, and it's one where it's how you react to that, and like let it be that foundational learning lesson, and use it to empower better habits on a go forward basis. And it's one where like you gotta be creative and use the resources. And if anything, like from my perspective, I used it as an empowerment tool to work harder and make more and do more things and like create what I've created. And a lot of it was to be able to get through some of those harder periods of time in life.
Yeah.
So.
Yeah, I agree.
Morgan, thanks so much. I think this was a productive podcast. I know it kind of took a couple pivots from where we prepped on it, but
we come back to it, the good versus the bad, right?
Well, I think it's an empowerment conversation. It's one that we have all the time with our clients. I think, this is probably one that for our clients listening to it, send it to their kids, because it's a great way for us to be able to add some value for them as well.
Yeah, absolutely. Thanks, James.
Hey, thanks so much. Appreciate it.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.